Hello everyone. In this video, I will be covering the net income of a company. What is net income? Net income is a company's final profit or loss, calculated after all expenses are paid. It's measured over a specific period, either quarterly or annually, which is why you'll see it updated regularly on stock pages. Investors use net income to judge a company's overall business success. It shows whether the company's revenue model actually works, not just whether it can generate sales. Because it captures the full price of income and expenses, net income is one of the most closely watched numbers on any stock page. At its simplest, net income can be thought of as total revenue minus the total operating expenses. So, what does the net income include? Net income includes all of a company's day to day operating costs, the regular expenses needed to run the business. This includes the cost of producing goods or delivering services, employee salaries and benefits, marketing and advertising, R&D, and general administrative expenses like rent, utilities, and software. Because all of these costs are included, net income doesn't just show how much a company sells, it shows how efficiently the company operates. Two companies can generate the same revenue, but the one that controls its operating costs better will report higher net income. That's why net income is such an important measure of operational efficiency and overall business performance. So, why does net income matter to investors? Investors care about net income because it tells them whether a company is actually profitable, not just generating sales. It shows whether the business can turn revenue into real earnings after covering all its operating costs. Net income is also used to calculate earnings per share or EPS, which we will get into in next videos. EPS is one of the most important metric investors use to evaluate a stock. Because of this, net income plays a major role in how companies are compared within the same industry. When net income grows consistently over time, it usually signals strong management, good cost control, and a business model that can scale. On the other hand, declining or inconsistent net income raises concerns about rising costs, slowing demand, or long term sustainability. That's why investors watch net income trends closely, not just a number in a single quarter. Positive versus negative net income. When net income is positive, it means the company is earning more money than it's spending. This usually indicates that the business model is working and that revenue is covering the company's operating costs. Positive net income also gives the company more flexibility. It can reinvest in growth, pay dividends to shareholders, or reduce debt. When net income is negative, the company is spending more than it earns, resulting in a loss for that period. This isn't always a bad sign. Many growing companies, especially startups or high growth tech firms, intentionally operate at a loss while they invest heavily in expansion, product development, or customer acquisition. What investors really focus on is the trend and direction. They want to see whether losses are shrinking over time and whether there is a clear and realistic path towards future profitability. To wrap it all up, net income is one of the most important numbers you'll see on a stock page. It represents a company's final profit or loss after all expenses are paid, and it shows whether the business is truly making money. Investors rely on net income to evaluate profitability, efficiency, and long term sustainability. Looking at net income over time helps reveal whether growth is real, improving, and repeatable. While no single number tells the full story, net income plays a key role in understanding why a company's revenue model actually works. That's why it remains one of the most closely watched and discussed metrics in investing.